Is Nvidia in trouble? Can a single AI breakthrough shake up the world's most dominant chip maker? Nvidia has long dominated AI hardware, powering the tech revolution. But a new breakthrough by Chinese AI company DeepSeek is making investors question its future. With billions pouring into AI infrastructure, will Nvidia stay ahead or is the game changing? Let's find out. My name is Andrew Stotz, and I want to welcome you to this Valuation Masterclass case study. For over 30 years, I've been helping thousands of finance professionals master company valuation in months, not years. In this video, you're going to discover DeepSeek's impact on NVIDIA's long-term growth prospects, analyze the effectiveness of NVIDIA's competitive advantage, and evaluate NVIDIA's potential using my global stock tracker. Remember to click the link in the description to get this presentation and my global stock tracker of the top 500 companies for free. So, what's the company's story? NVIDIA is the engine of the world's AI infrastructure. It's an American multinational corporation that designs and manufactures graphics processing units, or GPUs, and other hardware and software. It was only founded in 1993. It's just incredible. That was the year I started my career as a financial analyst in the stock market. By Jason Huang and his co-founders, the company initially focused on gaming GPUs, which is what I knew it for in the old days, but has since expanded into AI, data centers, autonomous vehicles, and much more. 78% of total revenue comes from data centers, and 17% comes from gaming. That's quite a shift from the early days. NVIDIA powers some of the biggest games, bringing ultra-smooth performance to Call of Duty, ray-traced visuals to Minecraft, and delivering next-gen graphics to Fortnite. So the United States is NVIDIA's largest market, driven by, obviously, the US's booming AI and data center demand. That's 53% of NVIDIA's revenue is coming from the US. China is 20%, Taiwan is a massive 27%. So let's talk about DeepSeek's impact on NVIDIA's long-term growth prospects. The emergence of DeepSeek had a significant impact on NVIDIA. The announcement of DeepSeek's more efficient AI model sparked concerns among investors. And I don't know about you, but I've been using DeepSeek and comparing it against ChatGPT, Gemini, and Grok. And I've been doing this for a while to understand which one is best. And definitely DeepSeek is up there. I would say, from my experience, ChatGPT still delivers a better result for my purposes, but I'm testing it to see. Now, the stock price of NVIDIA saw a huge decline of 17%, erasing nearly $600 billion in market value when DeepSeek news came out this is Monday, the 27th of January. This is a great example of a one-day event that would be almost impossible to predict. So what does it mean? The success of DeepSeek indicates that future AI developments might not require the most advanced NVIDIA hardware, potentially affecting the company's market position. Moreover, DeepSeek's model used much less computing power, possibly leading to lower overall GPU demand for large-scale AI. And if demand is not there, well, all of a sudden, the very high valuations that we're paying for NVIDIA could be gone. But the stock rebounded 9% just the next day, as investors quickly took advantage of the dip. In other words, out of the $600 billion market cap fall, there was a $260 billion rebound. And in the long run, NVIDIA's growth prospects remain strong. DeepSeek is an AI model developer, not a hardware company. And even if its DeepSeek models gained traction, NVIDIA benefits from increased AI demand. And major tech companies like Amazon, Microsoft, and Meta, and Alphabet have collectively committed around $280 billion for AI data centers in 2025, ensuring strong demand. So, what's the story on the company? Well, NVIDIA is a powerhouse in the AI chip industry, and despite the DeepSeek challenge, NVIDIA remains strong. So what's its competitive advantage? The company is in the semiconductor industry, and they've got 30,000 employees and $61 billion in revenue. The majority of that revenue is coming from data centers. Now, what's its competitive advantage? Well, its competitive advantage comes through the dominance of high-performance GPUs and AI acceleration, driven by a robust hardware, software ecosystem. And how did it achieve it? Well, it achieved it by cutting-edge GPU innovation, proprietary CUDA software, and strong industry partnerships and continuous investment in AI and data center technologies. Nvidia's biggest moat is the integration of hardware, software, and AI leadership, creating a deep ecosystem that is hard to replicate, making it difficult for competitors to displace Nvidia. Nvidia dominates the GPU market with superior hardware and software capabilities, and they lead to high-performance computing, AI, and gaming. So Nvidia is the go-to brand for gamers with its GeForce or GeForce GPUs, which means it's basically dominant in gaming GPUs. Now, the Compute Unified Device Architecture, or CUDA, is Nvidia's special software that helps GPUs work faster for tasks beyond gaming. It lets developers use Nvidia's graphic cards to speed up things like AI, video editing, and scientific research by handling many tasks at the same time. It's a unique software that only works with Nvidia GPUs, thus locking people into Nvidia's ecosystem. Now, Nvidia's GPUs power AI workloads, including ChatGPT and other large language models. Nvidia recognized the AI boom early and positioned itself as a leader in AI acceleration, and they did it very, very well. I mean, this is a masterclass in shifting. Now, while Intel and AMD focused on general purpose chips, Nvidia developed GPUs optimized for machine learning. While competitors are now just catching up, Nvidia keeps innovating. And strong partnerships with Google, Microsoft, and Amazon Web Services ensures its dominance in AI computing. So, what is the company's competitive strategy? Industry-leading GPUs seamlessly integrated with software like CUDA and a powerful AI ecosystem. So does the strategy lead to a competitive advantage? I use my world-class benchmarking scorecard to measure if a company has a competitive advantage. I developed this scorecard about 10 years ago, and here's how we construct it. We gather yearly and quarterly financial data of 26,000 companies worldwide. We then calculate each company's profitable growth score, which is a composite measure of both profitability and growth. And then after that, we rank the company relative to sector peers of a similar size. A decile ranking of 1 or 2 is financially world-class, while 10 is the worst. Now, we assess the company's performance over the prior 4 years and the past 12 months. So is Nvidia financially world-class? In other words, does its strategy lead to a competitive advantage? And the answer is absolutely yes. Nvidia is ranked a number 1 when compared against 610 large infotech companies worldwide. That profitable growth score is tremendous. Now, revenue growth has been highly volatile, but consistently above the global average. In fact, it's the type of volatility that you want. It's the massive upside volatility. Now, people thought in 2017 and 2018 that about 40% growth in revenue was significant until we got the post-COVID era of 2021 and 2022, where it was almost 60% on average for those 2 years. But that was nothing compared to the 126% revenue growth that happened in 2024. Part of what's happening here is Nvidia has the opportunity to raise prices massively. So, does its strategy lead to a competitive advantage? Absolutely yes. Nvidia has shown consistent profitable growth according to our scorecard. So what does the valuation look like for the company? Well, the stock price has been on a strong upward trend since 2023. It's been consolidating a bit recently over the last 6 months or so, but let's apply my global stock tracker to assess the attractiveness of the company. Now here we can see that it's the largest by market cap company in the semiconductor equipment industry at about $2.9 trillion in market cap. But the fundamentals show us that net profit margin is an incredible 56%, which is already massively higher than the 33.5% for the industry, which is already massively higher than the average of about 6 to 10% recently of net profit margin globally. And here we can see if we compare net profit margin of Nvidia of about 49% against AMD about 4%, AMD really is a disaster, unfortunately. Now, ROA is significantly higher than the industry average at 94% versus 42% for the industry average. Next, let's look at valuation. I like to look at PE and price to book. So PE is below the industry average, suggesting it's not overvalued. Well, let's go back and look at that. The industry average is driven by PEs that are massive for Applied Materials of 256 times PE, Broadcom 178 or 177, and Advanced, so it's just incredible what's going on there. So we can see very high PE ratios in the industry, and Nvidia's PE at 46 is still extremely high relative to the overall market, but you could argue is not that high. But if we look at price to book, it's another story. And I like to look at price to book because sometimes some companies have low levels of earnings because of some reason, maybe distress, maybe a bad quarter, maybe they write off something. And therefore, the price to book value tends to be a little bit more of a guide. And here we can see the price to book value of Nvidia is 44 times versus 21 times for the industry. So Nvidia is in fact expensive based upon price to book. And that would lead me to say that the PE ratio of the industry is exceptionally high in that number. And so I'd be careful there. Now let's look at momentum. I like to look at EPS, or fundamental momentum, and price momentum. And here we can see EPS momentum has been incredible, up 235% Q on Q versus about 70% for the industry group. Now, EPS growth has been consistently higher than the global sector average, including 360% EPS growth in 2024. Now, the recent price change indicates some market pullback. We can see Nvidia's down about 13% at the time I did this graph versus the industry at about flat. And finally, let's look at risk. Well, we can see that it's a net cash company. It's got 26 billion in cash and 23 billion in debt, meaning only 24% of assets are financed by debt. And the beta is about 3.1 versus 2.3 for the industry group. So it's a much more volatile stock. Now, remember to click the link in the description to get this presentation and the global stock tracker of the top 500 companies for free. But I want to now ask you the question, is Nvidia in trouble? My answer to that question is probably not. The share price may be a bit expensive, but the company is in a very, very strong position. What do you think?